Hello, everyone. Thank you very much for having me. I'm Anton Moiseienko from the ANU Law School, where I've been for the past 4.5 years. Previously, I was working on anti-money laundering and counter-terrorist financing in a policy role in the UK, and I felt like probably half of my waking life was spent at various financial crime events where people were bemoaning the state of the anti-money laundering regime. And those of you with familiarity with this area of regulation and practice will recognize the diagnosis. The diagnosis is that banks and other regulated businesses need to comply with onerous customer due diligence and suspicious matter reporting obligations. A lot of the reports that they produce are a product of over-reporting out of fear of regulatory action rather than a genuine attempt to advance law enforcement objectives. And therefore, as a result, governments are flooded with suspicious matter reports, and the entire regime costs billions to maintain. Does it produce law enforcement value that is good value for money in that context? That's the kind of conversation that one would hear almost without exception at any gathering of financial crime experts. And so the academic project that I wanted to run 2 years ago was focused on looking at the history of the anti-money laundering and counter-terrorist financing regime and developing a better sense of how we got here. How is it that we arrived where we are, where the financial crime regime is so universally critiqued and in some cases vigorously criticized for failing to deliver on its mission? And that led to another important question of what is actually the mission of the anti-money laundering regime, hence the title, The Conflicting Objectives of Anti-Money Laundering Regulation. So the book that lays out the results of the project is called Doing Business with Criminals, and it was published last year. And as you can see, there are a number of points that I tried to tackle in that book. The central question is, why is today's AML-CTF regime the way it is? Why is it, according to so many people working in this regime, so intrusive, so ineffective, so inefficient? And very importantly, could it look any different? What are the features of the regime that are inevitable versus features that are contingent, could have developed in a better way, and perhaps can still be reworked, reimagined, re-envisaged? And then that led to the question of, if we accept the diagnosis that what private sector businesses are doing is not really serving law enforcement objectives, well, how can those efforts be better aligned? And the way that I started about that project was to look at what I describe as the forgotten, or perhaps more accurately, half-forgotten history of AML. And it's half-forgotten in the sense that even if you talk to experts in this field, and many of you are here today, we generally speaking have a sense of some of the main milestones. So the regime as we currently know it originates in the Bank Secrecy Act in the 1970s in the US. It was expanded in the 1990s at the international level, further embraced counter-terrorist financing after 9/11, and so on. But the question that I wanted to really understand better is, if we look at some of the key components of this regime, so customer due diligence, suspicious matter reporting, the problem of people being de-risked because they have the wrong passport and can't get access to banking services, when did those elements come together, and what was the policy thinking that underpinned them? And did people foresee some of the unintended consequences in the 70s and 80s and the 2000s as the regime was emerging? And one of the things that I found quite striking is the sheer length of time that it took for the AML-CTF regime to emerge. In real terms, the rules that we are now all familiar with started in 1970 and the 1990s, as I've discussed. But in a way, their genesis harks back to a far earlier period. There is a degree of arbitrariness as to where you draw that line, what is the source of the Nile. But I thought that one sensible point to start with was the 1920s, and the prosecutions that were brought in the United States based on a holding by the US Supreme Court in 1927 that if you have criminal income you need to report it for tax purposes. Because that, for the first time, caused people to engage en masse in what we would today recognize as money laundering. Because you couldn't simply spend lavishly and expect no questions to be asked. You needed to report that to the taxman and come up with a story that would cover your funds with some plausible deniability, or you needed to conceal that wealth through nominees, proxies, companies that you held, and so on. Of course, one of the first victims to these laws, the tax application of the criminal law, was Al Capone, and it's rather entertaining today to read some of the documents that were published by the Internal Revenue Service decades later, detailing some of the investigations into Al Capone. You see an example here of those very early financial investigation techniques that, of course, are suitably simple for that age. You see here, Al Capone never had a bank account, and only on one occasion could it be found that he ever endorsed a check, all of his financial transactions being made in currency. But he did endorse a check, and the government was able to prove that he'd had more wealth than he had declared. And that happened to many other mobsters at the time. What is quite striking, I think, is that here we have something that resembles financial investigation and an effort to go after the finances of organized crime, and that's 1931. But again, it took decades until the 1970 Bank Secrecy Act was adopted in the United States. There were multiple presidential commissions in the meantime, some of which focused on the issue of the financial footprint of organized crime operations, others did not. It took until 1970 and the problem of foreign bank secrecy for the US to adopt first proper anti-money laundering reporting rules. And the problem was that gangsters secreted their assets away to Switzerland and other countries. The United States was not getting any cooperation from those jurisdictions, and as a result, it adopted reporting requirements that were binding on American banks to get a better sense of the financial flows coming out of the country. So that's, as it were, the first step, the first pillar of the contemporary anti-money laundering regime. Again, importantly, it developed over many decades in a very incremental process. It's the opposite of the caricature of governments rushing in to regulate and create rules around money laundering that you often hear presented. Quite interestingly, the other pillar of today's regime, customer due diligence, developed in the US nemesis of the time, Switzerland, the country that was the destination for all those suspicious financial flows. And there was a domestic political scandal that accounted for that, known as the Chiasso scandal. In 1977, a branch of Credit Suisse in Switzerland, in a town called Chiasso, close to the Italian border, was accepting deposits from wealthy Italian customers. There's a report by the New York Times from that period that described Chiasso as a town within suit-carrying distance of the Italian border, which gives you an indication of what was happening there. People would literally take their suitcases full of cash, ferry it over the border, and deposit it with the Credit Suisse bank branch. The problem that became transparent later on is that the bank managers in that outpost of Credit Suisse were running a Ponzi scheme as well as a tax evasion scheme. So at some point, the unhappy customers could not withdraw their deposits. The branch collapsed, the scandal engulfed the Swiss financial sector, and as a result, the Swiss government said, we need to clean it up. And one way to clean it up is to ensure that Swiss banks can't provide services to customers without having any clue as to who those customers are. And so a proto-due diligence obligation was enacted in the due diligence agreement that was concluded by the Swiss National Bank and the Swiss Banking Federation. Interestingly, still in force, so if any of you are interested, you can go onto the website of the Swiss banking regulator, you can read the text of the agreement as amended, and you can also see enforcement actions that have been taken under the agreement over the intervening decades. And somewhat to my surprise, it is actively enforced. There are banking institutions that receive substantial fines for the breach of the provisions of the agreement. So the notion of customer due diligence arose in Switzerland at the time. Of course, it did not prevent Switzerland from continuing to be a sought-after destination for proceeds of multiple crimes, but it was another piece of that puzzle of the evolution of the anti-money laundering regime. And then, of course, the criminalization of money laundering, famously enacted in the United States and the United Kingdom for the first time as relates to the proceeds of drug trafficking only in 1986. Again, very far from a sort of penal populist governmental reaction to scandals. It was something that was really, in the United Kingdom in particular, a response to a case called Cuthbertson, where the House of Lords, at the time the Apex Court, decided that the government had no legal power to confiscate proceeds of drug trafficking. The judge who penned the lead judgment in the case, an eminent jurist, Lord Denning, then spoke on the floor of the House of Lords and called for the government to adopt laws against money laundering. And you see here the sort of colorful quote that one can still read in Hansard from the time. Is it not the case that huge proceeds of bank robberies and airport robberies are spirited abroad almost at once, and, to use an expressive Americanism, they're laundered through the banks so as to make them apparently clean, and then brought back by the rogues and put into the hands of apparently innocent people? Is it not time that legislation was introduced to freeze those proceeds, to prevent the rogues from making use of them, and to confiscate them? He is not explicitly referring to criminalization, but criminalization took place as well. And so what we have again is this international, cross-Atlantic conversation as to the right ways to go after the proceeds of organized crime and people who facilitate money laundering. Similar developments were afoot in Australia as well. And so this is a brief historical excursus that shows some of the stage, not all of the stages, but some of the phases in the evolution of the regime. Now, what does that mean for AML-CTF of today? Well, this is where we get, and I'll skip the FATF part of the discussion. The FATF was convened in 1989, partly as a result of the French political ambition to hold an important international summit. The Financial Action Task Force was first convened to focus on the proceeds of drug trafficking and internationalized those approaches that we've just been talking about. But what all of this means for the regime today is that what we have is evolution rather than intelligent design. No one really came together at one point in time and said, let's design an anti-money laundering regime from scratch. Even when the Financial Action Task Force met in Paris to produce global standards, global recommendations in this area that are incredibly influential, they were drawing on those experiments in the United States, the UK, Switzerland. They were brainstorming from the ideas that had been tried and tested with varying degrees of success, almost always nascent. And what all of this means is that the regime is a product of this agglomeration of different rules and practices that do not really pursue one single set of objectives. And this is something that became abundantly clear, again, over the course of that policy work that I've been undertaking over the past 10 years, where you speak to compliance officers from various banks and you hear completely different views of the world. Some of them are terrified of their bank coming into contact with proceeds of crime because of the regulatory risk, because of the enforcement risk, indeed the reputational risk. Others, you talk to them and they say, look, I'd love criminals to bank with my institution because then I can feed valuable information to my law enforcement contacts. So the AML-CTF regime does not resolve the contradiction. It contains rules that are aimed at keeping the proceeds of crime out of the legitimate economy, including the criminalization of money laundering. It also contains rules that are aimed at surveilling criminals as they interact with the legitimate economy. and that is a different objective. Sometimes they are compatible. They're compatible in the sense that you can't just bank criminals, bank cartels and others without telling anyone. But they're also incompatible, because if you're a bank and you de-risk aggressively and you don't engage with companies or individuals who sound as though they might potentially have a whiff of criminality around them, then what we have is a displacement effect. And if all the regulated businesses take that approach, then our financial sector looks very differently. It looks very differently in the sense of depriving perfectly innocent people of financial services because they have, let's say, the passport of a high-risk country. It also results in all that custom being swooped up by non-compliant businesses, or businesses that are very happy to play fast and loose with anti-money laundering rules and bank high-risk customers without any controls. So the two approaches of exclusion and surveillance are to some extent contradictory, and they involve a balancing judgment. If you are in charge of compliance in a bank, which way do you err? What is your risk appetite? The extraordinary thing about the regime is that these important societal judgments are delegated to the private sector to make. Whether you accept high-risk customers, whether you bank lawful cannabis companies in some jurisdictions or gambling companies in jurisdictions where they are lawful, etc., is a private matter for a bank. But the way that regulated businesses go in the aggregate shapes our commercial realities. Those are decisions with profound public policy consequences. So what I describe in the book is this regime of not only delegation of essentially law enforcement judgments to private businesses, but undirected deputization, where those important decisions are taken by private businesses with no particular incentives for them to get the right balance in the sense of a balance that would suit law enforcement objectives. There are other relevant factors as well. So, for example, the presumption of innocence, or the contrast, the contradiction between financial surveillance and financial privacy. We can imagine a very effective regime of surveillance of suspected criminal activities, but the more effective it is, the greater the privacy trade-off. So what then are some of the high-level findings from the book? Well, first of all, as I've outlined, the AML regime is not seeking to achieve one single objective. It involves a balancing of competing values. Who does that balancing? Generally speaking, private sector businesses, regulated businesses, who have to decide what customers they take on, need to decide what they report, and very often one hears this pejorative term, tick box compliance, but what it really refers to is regulated businesses doing what's simplest and easiest and cheapest for them. Can you fault them for over-reporting when their incentive is to avoid regulatory action? So of course they over-report. They over-report, but also it costs money to surveil high-risk customers. It costs money to pay for all those compliance people filing the reports. And so another incentive is to de-risk from high-risk customers. You report them once, twice, or 3 times, and then you say, this is not a customer for us. So the private sector does what it is expected to do, but in a way that's cheapest and easiest for them, with a very minimal, if any, set of incentives to get a balance that produces socially desirable consequences. So then, here are examples of that dilemma that I've spoken about already. I don't want to belabor the point, but they are absolutely crucial because the answers to those questions lead to de-risking, people not being able to access banking services. They also lead to the point of the regime being subverted if worthless reports keep being sent to law enforcement agencies solely in order to address the risk of regulatory censure or regulatory penalties. So the argument that I make in the book is that the regime that we currently have is sound in some respects, none of the ideas that were floated in the US, Switzerland, the UK, and formed the basis of our AML-CTF rules are crazy. They're sound ideas. It's just that combined in a single regime and left for the private sector to implement, generally speaking, they're not underpinned by the incentives for regulated businesses to genuinely seek to advance law enforcement objectives. And so the kind of pyramid of compliance that one might think of is there's non-compliance at the bottom, businesses that just don't care. There's tick box compliance, which pretty much everyone is involved in, so you comply with the regulatory requirements, but whether or not this compliance advances law enforcement objectives is out of your hands. You don't really even know, as a private sector business, what is the right approach to take. And so the kind of higher state of compliance would be purposive compliance that's genuinely advancing law enforcement objectives. So, for example, in the case of a criminal group that needs to be kept within the perimeter of the regulated sector, they are allowed to maintain their accounts but are being reported on. In other cases, it might be worthwhile to just shut out a particular criminal threat actor from the legitimate economy. It's incredibly difficult for regulated businesses to make those judgment calls. There are initiatives around the world trying to bridge that gap and to bring private sector compliance practices into closer alignment with law enforcement objectives. Australia has been doing well, I would say, compared to the global room temperature in terms of trying to experiment with these initiatives. Australia is one of the countries that has a well-regarded public-private partnership, the Fintel Alliance, that Austrac is part of. It recently legislated for formal keep open laws that enable law enforcement agencies to go to banks and other regulated businesses and say, can you please keep providing services to this customer? You will be immune from prosecution, but we need to have access to information and intelligence about that customer. But there are also other ideas that have been tried and tested elsewhere. For example, targeted reporting regimes aimed at a particular geographic area, the geographic targeting orders in the United States. There are also other potential ideas that have been floated around. One of them that I find particularly contentious and provocative, although it was introduced first in 1984, not introduced but proposed in the United States, was considering rewards for high-quality reporting for regulated businesses. They need not be monetary rewards necessarily, but they can be in the form of a relaxation of certain sets of rules that otherwise would have to be complied with for businesses that are genuinely making progress in terms of providing high-quality intelligence that advances the fight against money laundering. A very modest version of that would be more regulatory praise, the opposite of regulatory censure. So if a particular regulated business is doing well and is trying to go beyond the tick box compliance, what is the best way to recognize and facilitate that? That is the kind of conversation that the global standard setter, the Financial Action Task Force, has not really been engaged in. And that, in a sense, is the main message of the book, that this is the conversation that's worth having. What we need now is not talking quite so much as we did in the 90s and 2000s about the laws that need to be adopted against money laundering. Generally speaking, states are already there. They've adopted those laws. We need to continue talking about law enforcement resourcing and the capability of law enforcement to address money laundering, absolutely. But the other piece that's missing so far is a conversation around the incentives of the regulated businesses and how they can be incentivized and gently prodded towards advancing those law enforcement objectives. Thanks very much.